Active duty passive income. I am Eric Upchurch, one of the co-founders of ADPI. Today we are joined by Derek Morrell, who is a former Marine, and he is our lead policy strategist at ADPI Insurance, which a lot of you probably don't even know ADPI Insurance exists, but hey, it does. And we're doing some amazing things, and a lot of it is because of this man we're interviewing today. So today we're going to be talking about something that is pretty cool and pretty controversial, but controversial is what grabs people's attention. And man, anytime you talk about this subject, Derek, people gravitate to it and comments go nuts anywhere we talk about it. So go ahead, introduce yourself real quick, say hello, and we'll dig into some questions here.
Hey guys, my name's Derek Morrell. I live in Houston, Texas, and actually, ironically, we're getting ready to move across country here in about a week and a half. So we've been having our hands full with that, but I am a full-time real estate investor down here in Texas. I'll still continue doing that, some virtual stuff when I'm in Virginia. I'm moving to Virginia. This topic, guys, I've been doing it myself since 2015-ish. And I jumped on board with some of the guys from ADPI. I used to do videos just to talk about it. So they talked to me and we decided to do some stuff together, and here I am.
Awesome. Well, we're definitely glad to have your expertise and knowledge on this, and your passion, man, about what we call the Cashflow Accelerator. And we're going to dig into some of that. So let me start off with some of the basics. So today, guys, just in general, for those of you listening who don't know yet what we're discussing, is whole life policies and high cash value whole life policies, why they're controversial, how to use them, who they're for, who they're not for. And so I'm going to ask some questions that I feel like were important to me when I was getting started in learning with this. And hopefully you all can comment and reach out to us and ask those questions directly when you have them as well. So in general, what in the world is whole life insurance, and why do we call it a cash flow accelerator?
All right, great question. So I'll try to break this down really simple. A lot of us know what term insurance is. We all get it in the military, or you get it for 20 years or whatever it is. And then after 20 years, it goes away. Or you can keep it and it's sky high price. That's term insurance. So that's one side of the aisle. We're not talking about that. We can use that to supplement our stuff for strategic purposes, but that's term insurance. What whole life is, there's a permanent life insurance umbrella. So imagine this umbrella. And you have a couple, 2-3 products. You have this umbrella. You have whole life is one piece under it. You have index universal life. You have variable life. So there's a few products under permanent insurance. Permanent insurance just means that as long as you're paying the premiums, it never goes away. Meaning if you die at 95 years old, there's going to be a death benefit to leave your heirs. That's what permanent insurance is. Now, under permanent insurance, we are focused on whole life insurance. And one of the reasons, as Eric said, high cash value dividend paying whole life insurance, that's just a vehicle. It's not like we're in love with life insurance. That's just a vehicle that we can use in our country, the way our laws are set up, that is very efficient to essentially you're kind of starting your own bank, and then you're using it to fund your life, to fund investments and all that. So that's what whole life is. Whole life, and I'll say this real quick to end the question here. There's a lot to it, as you could tell. So I'm trying to give the high points. Whole life insurance is just the name of a product. So if someone says, if we're talking whole life insurance, and you go find a friend from State Farm and they're like, oh, we do whole life insurance, that does not at all mean that's what we're doing. It would be like if someone says, hey, I have an IRA. Okay, cool. Is it good? Is it bad? What is it invested in? There's all those kind of questions. So that's the same with whole life. So we're going to be zeroing in on what we do under whole life, which could be vastly different than what other people do with whole life insurance.
Yeah. And one of the things I've heard in the past is when I think of working with an insurance agent, I know that there's a lot of money to be made in insurance. I know that insurance agents can make a lot of money, is what I mean by that. And so a lot of stigma kind of goes to, man, these insurance agents are creating it's not the individual's fault. The companies are set up to create a whole life policy that benefits the company more than the individual, right? They're just set up not incorrectly. They're just set up not for what ADPI wants to teach. And by the way, guys, we are not giving financial or legal advice here. This is opinion and based on personal experience and Derek's expertise. Just wanted to put that caveat in there. But so generally people think, okay, policy and these agents are just trying to make a quick buck or whatever it is, and it doesn't benefit me. And there's a lot of stigma around that. And that's why, we've captioned this. Dave Ramsey says, don't do this, because you hear that big name talking about don't buy whole life policies. It's different what we've created with ADPI Insurance and the Cashflow Accelerator. So we'll get into that in a second, but let's I want to get into some kind of bare bones basics. Like why can't you do the same thing in your bank account that you would do with a whole life high cash value policy that you're talking about? Why wouldn't I just keep cash instead of creating a product that I have to pay a premium on? Why?
Yeah. So there's a bunch of answers here. I'll try to pin it down to some practical stuff. When we do these policies, just for the context here, there's a bigger strategy. It's not just accessing your money. There's a death benefit, there's legacy, anonymity, there's all these tax-free stuff. There's all this strategy in one. But take that aside, let's just talk numbers. So let's say you had, I don't know, $50K, you save up $50,000 and it's in your checking account at Bank of America. And let's say your friend had $50,000 in his cash value of his life insurance policy. Well, let's say someone's going to buy a car. Okay. So someone takes $50K out to buy a car with cash. That's great. You paid cash for a car. Well, one principle, and then we can prove this, is you finance everything you buy, whether you're paying cash, whether you're getting a loan, everything you buy, you finance. And it's either financed through lost opportunity costs or it's financed what most people think of as interest rates. Well, when I take a $50,000 loan from the life insurance company, from my cash value, it is from the life insurance company. So I'm not taking my own cash. So what the life insurance company does, there is no underwriting. All they're going to do is they're going to look at your cash value. They're going to say, all right, you have $50K. And they're going to say, yeah, we'll send you $50K. You'll have it in a couple of days. That's it. That's your loan. So you get $50K cash in your bank account. Then you go buy your car. Now, what the life insurance company is going to do is they're going to charge you an interest rate. They're going to say, hey, we're going to charge you 5% a year. You don't have to pay it back. There are no terms. All this stuff is super flexible. Now,
you don't have to make next month's payment or ever.
No, you don't have to. Now, we suggest, we have strategies for it, but
there isn't a creditor coming after you if you don't pay your policy back.
There's not, and no one even knows you have this loan out. It's totally private. But here's the big key that people don't realize. If I take $50K out of my bank account, my Bank of America $50K, it goes down to zero. I have a car and it goes down to zero. Now, what are you going to do? Well, if you're super disciplined, that $50K got in there somehow, right? Maybe you pay yourself $1,000 a month or whatever it is, or you get some lump sums. Eventually you'll have $50K, probably in time to get another car in a few years. So all you're doing is you're paying back your own bank account. Okay, cool. There's nothing wrong with that. The difference is, the biggest issue on numbers is, because we're not using our own money, our $50K and our policy is still growing. Right now, these policies, the internal rate of return in this low interest environment is between 4 to 6%. So let's just call it 5, give or take.
Sure.
That means that $50K is still compounding at 5%. Now you might say, yeah, but there's a loan at 5%. Okay. Well, that loan at 5%, you're going to be paying it back because we pay back our loan. So we're treating us as the lender. When we pay ourselves back to our policy, the official, what's going on is it's just paying down that loan balance. But here's the catch. If you ever see a compound interest curve, like if you type in a time value money, if I invest 10,000 at 8% for 50 years, you see that curve, right? We always want to get to that hockey stick. If you keep taking money out of your bank account, you'll start a curve, and that's in a bank account, doesn't even make anything. But let's say you had a mutual fund or whatever, you start a curve and then you go back to zero. start over, go back to zero every few years. Not with whole life. Whole life, that sucker's going 5%, 5%. So when you're going up this curve, you're borrowing here. You're borrowing up the curve. And even though you're paying some interest rate to your insurance company, you're compounding and it's getting faster and faster. And then there's I can show this too. There's arbitrage, meaning even though you're paying down 5%, you're compounding at 5%, you're compounding on far more money than you're paying down. And there's some arbitrage there. And that's just to borrow money. That doesn't even matter what that 50K is going towards.
So this is an interesting concept because in real estate investing, obviously, active duty passive income is the premier military real estate investing education platform and community in the US. And we talk about, and which is why we've created ADPI Insurance and some other things, financial services. We talk about the way to do things a little bit differently, and also some of the streamlined common things, which are OPM, other people's money. In this case, sounds like what you're telling me and telling the audience is this is other people's money, but still your money, in a kind of an interesting way, an interesting strategy for real estate investing.
Yeah, exactly. And I will tell you that there's a lot of insurance companies out there. Right? You can go online. There's tons of insurance companies. The companies we use are only a small handful. They're mutual companies, meaning they're owned by us. So when I pay my 5% loan back, I'm kind of paying a company that I have an interest in. Now, for instance, one company we use has been around since 1847, but that's before the Civil War. They've never not paid a dividend. The other companies are very similar. These are like stalwarts in the business sense. And people don't realize this. Banks, Chase Bank, they put billions and billions of dollars into life insurance contracts because it's so safe.
Yeah. One of the interesting things that I see when I first, read Total Money Makeover by Dave Ramsey, which is a great book, but that's the first time I kind of heard the idea of like, don't use whole life and the argument against whole life. But then I realized also, as my real estate investing career or path progressed, is that the wealthy are the ones using these strategies. So, and it's not that they were wealthy and then used these, it's that they used these to get wealthy. And so the combination of whole life and real estate investing, I mean, you've heard over and over that there are more millionaires created through real estate investing than any other career out there. And this is a strategy that helped them get there. And when I started to learn that, I started thinking to myself, why isn't this taught in high schools? Why are we so sheltered and concerned about what one guru says about don't use it? It's because he's built an amazing empire around keeping it simple and small. And then, step one, but step two is, what are the wealthy doing and how can I employ? Because we're all smart enough to do it. We just have to know about it, and no one's teaching it. I mean, very few people are teaching it, and some people are teaching against it. So it is kind of this interesting dichotomy between what we're taught and where America is on education and what is actually working for the wealthy. So let me ask you this. Speaking about Dave, what about Dave Ramsey and others who say to buy term and invest in the difference? What about that statement? Buy term and invest the difference.
Yeah, and just so people understand what they're saying is they're saying, hey, look, guys, term insurance is dirt cheap. So you could, $50 a month, you can get a 500K policy. So that's what, $600 a year. So they're saying, hey, you could pay $600 a year versus this evil whole life policy. Maybe it's, $6,000 a year in premium. And then they'll say the difference is what, $5,400. So they're saying pay the $600 for term insurance, take that other $5,600 or $5,400, whatever, can't remember my numbers. Anyway, put that towards some investment, put that in the stock market is basically what they're saying. And that became a popular thing a few decades back. Here's the difference. And I want to say one thing about Dave Ramsey is when I first got started, I went through the same thing. I'm like, look, Dave Ramsey saying it's horrible. Susie Orman saying it's stupid, but there's some wealthy people doing it over here. Like, I'm like, what am I missing? I'm missing something. And then I realized what permanent life insurance was. Dave Ramsey, he's describing like the worst possible kind of whole life insurance where you put this big premium in, you got some death benefit, and that sucker doesn't build any cash value for the first 2 years. It's 0, then slowly builds cash value. After 20 years, you break even. That is a horrible policy. I'd agree with them on that, but that's not what we're doing. So what buy term and invest the difference. First of all, whole life, this product is a savings vehicle. It's not an investment. People get really mixed up on that. Now, I have some fancy calculators and I can show a bunch of stuff. But first of all, when you're doing these policies the way we're doing, there's only a percent of true cost that is out, that you're kind of out of pocket. And really, I always show people this. It's kind of like when you buy a house. These policies are very similar to a house. When you go buy a rental house, say it's 100K, the bank says, all right, you need to bring 20K to the table. No one's like, oh my goodness, it costs 20K to get a house, I'm going to lose it. No, because you know you're going to get it back through rents, through selling later on. Same way with these policies. So I could take the term policy of say 20 years times 600. That's a lot. That's a good chunk of money. That's far more expensive than the amount of money I paid in this whole life policy. It's just the whole life policy is kind of front loaded with some costs. And we show that we show exactly what that means, but you're going to get it back. Now, the other thing with whole life insurance, and I've compared this and I can show anyone that wants to see it. In order to compete with just this whole life policy, this boring 4 to 6%, let's call it 5%, just to compete, because that's growing tax free, right? It's really tax deferred, but the way we pull out money, it's always tax free. So it's growing without taxes. In order to have the same amount of return on the outside in a taxable account, you might have to make 7-ish%, maybe a little bit more, just to equal what we're doing. And you're stuck in an investment that you can't get out of it. Or if you do, it goes back to that zero. It's that compound interest curve. You don't have it. Because what we're doing is, if you want to invest in the stock market, if you're in love with the stock market, great. What you do is you take loans out of your policy and put that money into your investments. You take loans out of your policy, put that money into real estate, which is what a lot of us are doing. You take that money, put it into your Bitcoin stuff or whatever it is, whatever your investment is. This is a game of flowing money. So when we do our whole life policies, most of the time I can help people restructure what they already have. It's not like, oh crap, I gotta make all this extra money. Not really. We just flow it in a certain way. Same amount of effort. We're just putting it in a certain way.
Yeah, I've heard people in the past use the term velocity of money and how important it is. And that's something that in the last 5 years or so I've really realized. And I'm at the point now where it's recycling investment money to compound. And so this is a great vehicle in order to do that compounding. And I love the fact with a whole life policy that the type of whole life policy that you create, that when you take money out to use it in an investment, it still grows as if you didn't. I mean, I know you mentioned that earlier, but that's a concept that when you really just break it down, you take, say, $50,000 out for an investment, the policy is still growing at that interest rate as if you didn't take the money out. That's just an amazing concept to me that you could do that. Another thing, and I'm just kind of riffing here because all of these, this keeps on coming up in conversation now, the more you go down the real estate investing rabbit hole. And somebody mentioned to me recently that whole life policy helped them with their, instead of a 529 college fund, which would have counted against their ability to apply for their kids' financial assistance for college, a whole life policy isn't discoverable in that whole transaction. So it's a way for you to smartly use your money and build your money. It's a savings vehicle, as you said. So if you're using it to save for your kid's college fund or something, the college admissions aren't going to be able to look at your whole life policies. Is that correct?
Correct. So yeah,
that's huge.
Yeah. The FAFSA and all that stuff, the applications that you have to do. And not only that, but even from, your 529 and all that stuff, but even from the perspective of a business owner, So, someone buys a rental, sometimes they might put them in an LLC just to protect, because we're in a litigious society. Well, guess what? Say you got sued and you have $100K in your whole life cash value, and you have $100 in your bank account at Bank of America. Let's say, God forbid, you lost the suit or whatever happened. Creditors cannot touch your cash value in your policy. Now, caveat, every state has their own little twist on the law. Like Texas, they can't touch it. And a lot of other states, they can't touch it. And in some states, if they do touch it, it's like you can only touch 10K of it or something like that. And so it's a big protection, because that's what we're doing. We're building our financial kind of fortress here, our foundational place to pull money.
And I want to stop for a second, just say, if you're listening to this and you'd like to connect, go to activedutypassiveincome.com/CFA. That stands for Cashflow Accelerator, Charlie Fox Alpha. So activedutypassiveincome.com/CFA, and you'll get on Derek's calendar. Again, Derek Morell, former Marine, is our lead policy strategist for ADPI Insurance. All right, so why would I pay interest? This is another question, and I like tackling the basics questions, the things that I ask first, and I'm continually exploring as well. Why would I pay interest on to get my own money? Like, so this kind of goes back to the cash thing, but like just in general, why would I pay interest to use my own money? I really want to beat that in.
Yeah, great question, and we kind of alluded to it, but just more specifically, a lot of people, they're used to bank accounts. Like, I have 50K in my bank account. That's my money, and I'm going to pull it out and it's free. Well, with your cash value, it is your money. But if you want to pull that 50K out, okay, you can do a withdrawal and you can pull your money out and it destroys the policy, right? So why would we want to do that? So one way to access it is you take a loan. And what happens is your money's over here. This 50K is over here. The life insurance company comes over here from their coffers. And if you want a $20,000 loan for whatever, they'll look at your policy, say, hey, you got the collateral. What it is, it's a collateral, just like a house, just like a line of credit, essentially. The insurance company gives you their money and they charge a little bit of an interest rate. So it's not, but your money's still growing at that rate or higher typically. So you can call that a wash if you want. Just like if you had money in a bank account, you're not even making money in those accounts either. So that's kind of, if that makes sense. And we'll say this one more caveat. Once your balance in your cash value gets to, call it 65K, give or take, there's third-party financial companies that will loan against your cash value. So what they'll do is they'll do the same thing the insurance company's doing, but they'll do it cheaper. They'll give you a loan for 3.5%, 3.75%. So what does that mean? That means I take my 20K, they're going to collateralize to stay protected.
The policy.
Yeah. They're going to basically say, hey, you can have a line of credit up to whatever the certain limit is. So when you take that money, you're using that money. We're always using our money for something. It could be investments. It could be refinancing a credit card that you have for 15%. And then you pay yourself. Now you're the bank. So these third-party companies, you're literally making 1.25%, 1.5% just flowing your money this way. You're making that much there. Not a big deal, but look, you're making money just to use your money. And then you have your investment of whatever it is that you're doing.
That's interesting point too. So collateralizing your policy with a certain cash value in it so that you don't even use the policy. You're using a third-party loan against your policy at a cheaper rate.
Yep. And remember, if you had $100,000 rental house that was paid off, if you went to the bank and said, hey, bank, I want to get an equity line or something against my rental house, I mean, they're going to come in and say, all right, we'll give you up to 70%, blah, 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 of your equity. Well, if you had 100K sitting at your life insurance, I have policies where they'll give me 99% against what I already have. Mm-hmm. So they're very similar to property. I always like to bring it up, especially with the ADPI folks, because a lot of us are investors and things like that.
Yeah. And so that kind of leads me into a thought process along the lines of the why should I use this versus cash? So I have been just accustomed to using my home equity line of credit, or HELOC, because I have a large HELOC. I've been a great saver. I've been moving around from property to property and making money through kind of my live-in flips. And now I've got this, California house with a large HELOC that I have used for lots of different investments types. And I continue to do that. So my HELOC rate is 4.25%. So why wouldn't I just use my HELOC instead of a cash value whole life policy?
Yeah, it really comes down to the numbers. Now, not only the numbers, but the HELOC. I don't know what the arrangement is, but I mean, what if the economy changes up and they want to? I don't think they'll just give me my money back, but they could drop that credit line and all that stuff. It can go away. Yeah, that can't happen with life insurance.
That's a big one. I want to stop on that for just a second. So say I have $100,000 HELOC, just as a rough example, and I use it, right? And then they say, oh, by the way, we're reducing the amount of HELOC. So economy shifts or whatever, for whatever reason, the bank says you now only have a credit line of 80,000. I'd be underwater, right? I'd be over leveraged in that situation. Correct. And in my scenario, I'm liquid enough to not have that happen. So, whatever I borrow, I could have actually used cash, but not a lot of people are going to be in that situation as well. So I wanted to make that distinction. That's a good point. It's kind of the mindset of some of the audience may have heard, self-directed IRAs, right? Yeah. They're really cool. You have control of the money and you can do cool stuff, invest, because you want to control what you have. Well, the same way here. One of the principles is I don't want to be at the mercy of the bank. I really don't. I mean, we need a bank for stuff, but I don't want to be at the mercy of a bank. Now, having a large equity in your house, I think those are smart moves. Those are strategies where we're using the bank to our advantage. But I don't think we want to be at the mercy of the bank where they can just take the feet out from under us and take that money. So remember, with these policies, it's still a life insurance policy. There's living benefits. Like if you get disabled, you have a chronic illness while you're living, there's certain riders in all these policies where, if you can't do a couple tasks that most people can do, you can start tapping into your death benefit while you're alive. You can start, that's a huge thing, especially as you get older. Not only that, but you have death benefit. Right. So if you pass away right now, you might have multiples of any cash value you have, high multiples of it, which is another thing on Invest the Difference. Buy term and invest the difference. You can fast forward 30 years. The term policy's gone. They could have had a $2 million death benefit. It's gone. They die. So they have cash, whatever it was, whatever they invested. Okay, cool. That goes to your heirs. There could be taxes on the state taxes and stuff too, depending on the situation. Well, if you have the whole life policy, they're not getting your cash value. They're getting your death benefit, which is much higher than your cash value. Plus, if you're a good banker on banking on yourself, and if you are a good investor, plus you have all the investments. So yeah. So when you look at it holistically, it's a good move. That's cool to hear too, because you think of whole life policy, and we're talking about it as a savings and an investment tool, but it's a life insurance policy. So there's death benefit, and as you said, even a disability type of benefit in certain circumstances too. So that's another thing to consider. Pretty cool, and maybe an ancillary kind of function in this situation, but really cool to know. So let's talk about some of the differences. Actually, one of the things that before I get into the last question that I have for you. One of the things that comes up, no, let me just dig in right into the meat of it here. So what is ADPI? This is what really makes me excited to hear from you, because you're so passionate about this. And anyone who's watched your videos comparing apples to apples, I recommend you go check out some of Derek's stuff, because he really gets into the meat of it. And so let me ask you this question. What sets ADPI Insurance apart from those companies you talked about? Why did you choose to help us start ADPI Insurance with these particular types of policies specifically?
Yeah, great question. So just to give some background, when you guys reached out to me, I think Markian first did, he first reached out to me, and I remember talking to him when we were kind of going back and forth on just kicking the can around. I was like, look, man, if I come on board and help, I'm writing exactly what I'm doing, because there's so much garbage out there that I'm not going to be a party to that. Because when I write a policy, if I wrote a policy for you or for anyone else, it is the same thing I do if I wrote a policy for me, if I wrote a policy for my wife. And I'm happy to prove that, because I have written a policy on my wife and I can show it's the same ratio. Everything's 100% the same. The problem is why we are different is we set up the policies to optimize the maximum for the client. Now that sounds kind of cliche, like anyone would say that. But what I mean by that is insurance cut, and you said it earlier, there are commissions, but they're all baked into the policy, right? All the insurance companies have to do it. You can't get around it. The difference is the higher a premium someone pays, the more an agent gets paid, right? The lower the premium someone pays, the base premium, the more an agent, or the less an agent gets paid. The way we're setting these policies up, we want the base premium as small as possible. And then there's this other kicker that's a paid up additions rider. We want that as high as possible. That's what's spiking your cash value to increase very fast. We're after this for the cash value, guys. We're not really after it. Oh, by the way, there's this big death benefit. And if you're after it for the death benefit, then we can get term as well, and it can kick you up. The problem is a lot of other agents, they do this base premium much higher and they lower the paid up additions. We don't get paid hardly anything on the paid up additions. The lion's share of premium or of commissions come from the base premiums. So agents have a vested interest for themselves, if they're that way, to not tell you what they're doing. Increase your premium, they get paid more. And we don't do that. We simply don't do that. And the best.
Why not? I mean, I know why. I mean, obviously, but why would we want to create a policy where it's in the best interest of the client, where you've got to make money? So why would you choose to do that, I guess, is my question.
Yeah, great question. First, the reason is I'm going to do exactly what I'm doing for myself. We want to optimize it for the client. And again, that sounds like, oh, you're just saying that. But here's the deal. I want that client to tell all their friends, like, hey, look what ADPI set up for them. Look what they did. Because I have the great freedom I have when I talk to someone is a lot of people come they do a chat with me and they're like, hey, I already have this policy. Or, hey, I'm actually talking to an agent and here's these policies. And I'm like, great. Hey, those might work for you, but let me do something. Let me just compare apples to apples and let me run some stuff on our end and let's just compare. And then you tell me, no pressure. I don't pressure anyone into it. And so far, every 100% of the time thus far, we blow the other one out of the water with optimizations. It's as simple as that. So I have the freedom. I can talk to anyone and say, look, I'm going to make this thing as optimized as possible. Now, could another agent do the same thing? Theoretically, yeah. But here's the deal. I can use life insurance company A, right? And you could take me and 10 other agents that don't know each other, and we're all working for life insurance company A. And Eric, you say, hey, I got 10K a year I want to put in this thing. Okay, cool. We can all use the same exact life insurance company. We go into their portal and there's a bunch of levers you pull. We can all have vastly different products, vastly different, under the same life insurance company. So even agents that use the same company, because every life insurance company has their own stuff, even those agents can be vastly different.
Sure.
And it's because there is a human element here. We're not just hitting a button and it pops out. There's a human element where we actually look at what's more efficient.
Yeah. And when we created ADPI Insurance, I'll just piggyback on that comment. ADPI succeeds when our members succeed. That is ultimately why we created financial services. We're an education company primarily. And through that, the community started asking for services that are better, faster, cheaper, more military centric. And so that is what has made ADPI into what it is today. And that is what ADPI is in the future. When our members succeed, that is our fulfillment in the space. So thank you for participating in that and helping us grow something that we know is going to be huge and is already making leaps and bounds in this industry, in this insurance industry. And as a barrier to entry, education is the part that is lacking still. So with active duty passive income, educating, with ADPI Insurance now at the helm of the insurance space in the military world, we're going to do some amazing things, and we're really excited that that you're leading that effort. And so where can people reach you, and what's the best place for people to get started? Because I'm sure there's going to be a million questions in the comments, but also just in general. So where can people rebut something you said or really pick your brain or whatever it is?
Yeah. And I absolutely love haters, man. I love it. I love people like, oh, what about this? Or someone told me this. I love not being confrontational, but just discussing it, because look, if there's a better way, I want to know it. If you have some secret thing, great, let me know. And I'd love to chat. So I'm on Facebook, Derek Morell on Facebook. I'm in the ADPI groups. Probably the number one way to reach me and get some time to discuss this specifically, where I'm on video like this with you, is through the activedutypassiveincome.com/CFA. And that's going to get you kind of some answer a few questions just to help us out, and then get you on a calendar appointment. And there's also some masterclass links that you can watch, if you want to watch a webinar, kind of 40-minute webinar on this topic and stuff. So that's probably the best couple ways to get a hold of me.
Awesome. Yeah. And we'll definitely be pushing people your way. Derek, we appreciate all of this and kind of getting started in this space for ADPI and the community. Again, Active Duty Passive Income exists to serve this community. We are veterans, for veterans and military. And man, adding the insurance element to it is going to be huge for our members. And there was a large outcry for it. And then there's a whole subsector of people that didn't know they need it and will be interested in it. And so that's exciting to be able to present that. So appreciate your time. And we're looking forward to connecting again. Guys, again, if you have questions, activedutypassiveincome.com/CFA. Thanks a lot. Thanks for joining us.